Hi, my name is Rick Lear. I'm the Chief Investment Officer of Lear Investment Management. Recording this webcast today from our home in Dallas, Texas, as we are in shelter-in-place orders, as I'm sure many of you are out there. We're still working though. So today our goal, our purpose is to give you an update of our current thinking on the capital markets as it relates to the crisis and the current recession. It's become increasingly difficult in the last couple of weeks to separate the humanitarian crisis from this virus with the financial crisis created. But today, on this format, we're going to talk about the financial crisis. And we do so with much respect for those healthcare workers and for all of those affected by this virus. So we address this update in three sections. One is the financial system, two is the economy, and three is the actual COVID-19 virus itself. So let's start with number one, the financial system. Financial system runs on confidence. Confidence is the backbone of the financial system. People have to believe that banks are going to be able to give them their money, and people that make loans are going to have confidence that they're going to get repaid from those loans, and that there's liquidity and trading of all the securities involved in this. So the Fed, the Federal Reserve, having learned their lessons from 2008, acted early and big, meaning they implemented systems that give us confidence that the financial system will continue to work. They lowered interest rates to almost zero. They implemented a variety of lending and buying facilities and lending facilities to help aid in liquidity and serve as a backbone that this financial system will continue. So now we move to the economy. Fed can't do much in this situation to stimulate the economy or to save the economy, but they look to the government. So last week, the government passed a relief package of over $2 trillion. It's actually going to be worth a little bit more than that because some of the money can be loaned out. So we forecast maybe it's $4 to $6 trillion of relief. This is very good that this happened. You saw the stock market rally from this. But now the question is, how can they execute, and can they execute effectively and in a timely manner to get this money to the people in need? So the biggest question now is, how long will the self-induced coma of this economy last? Will the money from the government be able to bridge the gap from the shutdown until when we're able to return to some sort of normal? So that is the question. So right now, we look to the virus itself for some clues to that. So now we look at the virus itself. But right now, what you're looking at on the screen is the new cases versus active cases in South Korea. This is South Korea. We look to countries that have had experience with the virus as clues as to what we can expect. So as you will notice in the case of South Korea, cases peaked. They ramped up pretty fast, as you would imagine, because when you start testing, more and more people are going to be identified as having the virus. And then with isolation, social distancing, the cases were able to decline. And it's not even really the active cases you want to look at. You want to look at the number of deaths and who is actually affected. Let me say that again. It's not the number of active cases. There are many cases out there, many we don't even know about. It's who is affected and what is the number of deaths. I think what we're going to find in this data is that the actual mortality rate is much closer to the common flu. Okay, so now let's look at the who is affected. We've looked at Korea in age and Italy in age. And what you will note from these charts, we boxed them for you, is that the mortality rate for those over the age of 60 to 69 is much higher than the mortality rate of those below the age of, let's call it 60. I know this is controversial. The government does not want you to doesn't want you to think about this too much because they do not want the younger population to feel free to move about, and we agree. But it is very important to the question we're trying to answer: how long will we be in this self-induced coma? Very important is understanding who is affected and the mortality rate. And like I said, we're just presenting the data here. And I think what you will find is that it is very clear in the data that those over the age of 70 are the ones most affected. Now that we have an understanding of the financial system, that there is a foundation in place, we have a bridge in the economy, and we understand that the curve of the virus will flatten, and people will understand that those most at risk should be the ones continuing to social distance and shelter in place. But the question is, when can we return to work? And has the economic damage that has been done in this self-induced coma, has that economic damage been too difficult to unwind? You notice in the jobless claims the last 2 weeks, over 10 million Americans are unemployed. So the question now is, how long will they be unemployed, and will those jobs be there when the economy comes back? Many of those employees have been furloughed, and their jobs will come back. Some of them won't. Some of them will go to new jobs that are created. So now, as it relates to the portfolio, we entered this year in a defensive stance. We remain in an even more defensive stance, with the focus on owning securities that will have a high probability of surviving this, what we think is a deep recession. In order to do that, you want to have a strong balance sheet. You want to have a business with a moat around it, meaning a high barrier to entry. And you want to have a focus on revenues that do not involve something where a lot of people gather, like airlines or cruise ships or sporting events. All of those will return, but to get through this recession, we do not want to own those type of stocks. So we remain optimistic that the world will go on, and companies will survive this, and people will get their jobs back. But the extent of the damage is still just unknown. So we want to balance the risk in the portfolio and keep working and keep fighting to see another day. So what we want to say in conclusion is we appreciate all of you out there. We want you to know we are here for you. So please call, email, text, whatever, anytime. And please take care of yourself and your families. And we wish you all the best. Thank you.